time now to talk about what are the risks in investing in a bond that is listed.
Well, I think first, David, to sort of add a little bit more color, the retail bond market in Singapore is very, very small. There are less than 15 issues that are publicly listed and traded, and $1 million or so transacts a day. But it's a small market. I think that it's a very small market today, and there's some daily transactions for retail investors who can transact for as little as $1,000 in exposure. The wholesale bond market, which is far larger, a huge multiple of those 15 issues in the retail bond market, tends to have good OTC, over-the-counter liquidity, when the market is good.
Yeah.
But it's
the problem there is the minimum size, the lot size is $250,000, right? It's $250,000 sales.
Right,
yeah.
So by convention, it's a large size where investors may be taking on pretty substantial exposure on each single issue. And it's an over-the-counter market. An over-the-counter market has even less possible price discovery that's transparent to investors. But I think one of the key risks that investors need to understand on day number one, whether they're investing in equity or whether they're investing in a bond, is what is the underlying company, what is its business, what potentially are the prospects of its business, in order to form a view of what they think the likelihood of being able to pay back the interest as well as the principal for a bond, as well as succeed in their growth models. Right. That is the first and most fundamental thing that an investor needs to recognize, that there is a risk element in there because the company, if it succeeds, will certainly want to fulfill its obligations. But there may be circumstances beyond, in terms of its business model or the economic conditions, that forces it into a challenging situation.
But there isn't a source to which bond investors, individual investors could resort to, like equity research reports. We don't have bond research reports.
Perhaps if I can just take this a step back. Investment professionals like to speak of the risks attached to bond investing as creditor risk and interest rate duration risk.
Right.
But it might be more useful to break it down, reclassify, and then maybe simplify it.
Right.
So when we talk about creditor risk, it's essentially that promise to pay you a fixed income twice a year or whatever it is.
Issuer risk, isn't it?
Issuer risk is the creditor risk. So your entitlement to that fixed income and to your principal at the end of the life of the instrument on maturity. So that's the creditor risk. So back to your point, that comes down to an assessment of the financial strength and resilience of the issuer company. Now, not just at the point of issuance, but also an understanding of the resilience of the financial standing of the company under different levels of economic stress.
So where do the investors look for this information?
Well, that information is available from the people who sell you these bonds.
So they've got to ask for that.
They have to ask for it, and they should also look at the information that comes with
the memorandum of information that
it's info memo as well.
Info
so
memo?
Some of that information is there, and if it's not there, you should ask it from the people who sell you these bonds. So if I can come back to this point about creditor risk, of course you get a coupon, which is the payment divided by the principal.
Commonly known as the interest payment.
The coupon or the interest payment, that's absolutely right. But beyond that, you also have a market risk. Now, of course, if you're buying to hold to maturity, you don't really care about that mark-to-market risk. But if you're an individual investor or a retail investor, as they're commonly called, you might need to sell the bond if, for example, your son decides he doesn't want to do accounting at a Singapore university. He wants to become a singer and go to singing school in the US. You might have to sell some of those bonds. And the market value of those bonds will fluctuate depending on the interest rate environment, depending on the market's perception of interest rate movements, and also depending on the liquidity, because liquidity tends to amplify that mark-to-market risk. If there is not a lot of liquidity and people are trying to get out, they might have to sell substantially below where they paid for it.
So it seems to me, after interacting with many of these bond investors, individual investors, they're quite stunned because there has been a default. The point is there has not been a proper analysis at the point of buying who the issuer is, what is his financial strength, would he be able to withstand the global economic whirlwinds.
Or as Su Shan said,
Yes.
the price of oil.
Or price of oil. So we come to the default situation and discuss the key factors. Let me start with Sutat. The key factors that has affected the stability of the Singapore dollar bond market.
Well, let's put it this way. I think in the Sing dollar bond market in the last 4 or 5 years, which is still fairly nascent, there have been many corporate issuers who have issued high yield bonds, attracting investors who thought it was a very good interest rate. And in the first few years, where the economy was good and the issuers were actually getting better financing terms, they were actually early redeeming the bonds and therefore giving the investors their money back early. So this attracted many investors to assume potentially that it will always be a good result. And it will be not only a good result, but potentially an early result. In the last year, we've had about 13 wholesale bonds go into a default situation. And this represents a very small percentage of the total outstanding bond issues. But of course, if you happen to be investing in only one bond issue, it is extremely painful. So, as in all things, investors do need to look at the environment. They do need to understand that there is value in diversifying and potentially with more retail bond issuances where they can access fixed income instruments at lower principal amounts. That could be beneficial.
The majority of the defaults seems to be due to the oil and gas.
In the oil and gas
again,
sector, the oil and gas sector has certainly been very challenging. We've seen the oil prices go from $100 down to $20, and many of the firms in our economy here, in the marine and offshore space, have been going through some challenging times.
So, Su Shan, I mean, you've been dealing with bond investors for a number of years now. What do you gather as the most troubling factor as far as they are concerned?
I think it is the fact that, first of all, the investors, who suffered, perhaps did not anticipate, as you rightly said, that these companies would default. And in truth, when they were issued, a lot of these issuers, when they issued, things were good. They had contracts, they were liquid, their gearing was not bad at all. In fact, their gearing was good when they issued. But circumstances changed. And they changed fast.
And they couldn't get out, Su Shan.
Yes, contracts got cancelled. They weren't paid. People defaulted on them. And what maybe wasn't anticipated so greatly was the fact that the domino effect, one goes, the effect on others was pretty bad. It was like a whole chain, a domino effect of defaults within a concentrated sector.